Financial Services, joining us this morning. Mr. Sen, very good morning to you. I mean, honestly, all in all, despite everything, there seems to be a sense of disappointment with not just the large companies that are reporting, but across the board as well.
I wouldn't say disappointment. These are weak numbers, but these were largely anticipated going into this quarter. If you start with the macro data, there were no signs of growth revival in this first quarter. If you look at any high frequency numbers, and in a note a couple of weeks ago, we looked at a wide range of high frequency indicators and found that there was no evidence of a growth revival. Moreover, monetary policy transmission, which is what we are pinning our expectations on for a second half revival, is yet to happen meaningfully. So I think it's a little too early to expect the numbers to have come through. But by and large, I think these numbers were expected. And the evidence of that is that the earnings downgrades have not been that severe. We saw both in the October, December and in the Jan-March quarters when the results came, the earnings downgrades were very severe. That seems to have now stabilized, and we don't see that kind of severe earnings downgrade, despite, as you rightly point out, fairly weak numbers across the board.
Morning, Alex here. I'm just wondering if you can parse that for us. There must be some pockets that you're liking. There must be some results that you think stand out as winners, even amidst what we've seen so far, and quite a bit of ground to cover, I must admit, on the earnings front, but we've seen quite a few big numbers as well.
In the larger, sectors, there hasn't been any standout numbers. Some have just held up a little better than expected, but there haven't been any really standout numbers. A couple of the large banks may have reported reasonably resilient numbers, but they have. In smaller sectors, you will continue to see very, very strong numbers through the quarter. Those have been priced in. So, things like EMS and smaller sectors like that, you're probably going to see continued momentum. These are long-term thematics, but we like some of the spaces because I think expectations are low. Consumer discretionary is our top pick among all the sectors, and that remains so. But we warned that these quarter numbers for consumer discretionary, especially autos, will not be that exciting. But that's more a forward-looking view based on rate cuts spurring a second half revival.
Seshadri, good morning. Niraj here. So I guess that explains the contours of your note, right? Wherein I believe this week and maybe even the previous weeks, you've kind of made this point that you are adding SMIDs to your portfolio. That's very unlike what the commentary was 3 or 4 months ago from most people, that they were saying, let's bank on large caps because SMIDs are overvalued. You are saying quite the opposite.
Oh, absolutely. I've been consistently saying that, and I've, that if you're looking at a long-term investing thesis for India, you should look at SMIDs. There are 2 or 3 reasons. One is that the sectors that are emerging are largely SMID heavy. Whether you look at manufacturing, whether you look at some consumer discretionary sectors, etc. Also, within many sectors, more value for growth trade-off is better available in the SMID space than in the large cap space. And, financials, consumer discretionary, industrial, these are 3 sectors I can immediately sort of rattle off where SMIDs will give you more value for growth or, per percentage of growth than you will see in the large cap space. So I've been consistently saying that for quite some time and continue to maintain that SMIDs offers better opportunities. Now, there are some worries because the SMID indices seem to be trading at very high multiples. We pointed out in a note 3 or 4 weeks ago that is largely a mathematical outcome of some of the low P sectors like financials and energy having smaller weightages in the SMID indices. I'm not saying go and buy everything in the SMID space. There is undoubtedly pockets of overvaluation. There are many stocks which are undeservedly at 50 to 75 P. Please, be very careful when you go there. But there is still a large amount of value across the SMID space at reasonable valuations with growth picking up. Also, if we do see a growth revival in FY26, as we think we will, because of monetary easing and smaller amount of fiscal tightening, then you will see growth. SMIDs are more leveraged to high growth, so we'll see better outcomes across the SMID space. So absolutely non-consensus, but I maintain that SMIDs is the place to be if you're a long-term investor.
Seshadri, over the last, not just, this is too early days in the earnings season, but let's say over the last 4 or 5 months that your team would have looked at con calls, met management, so on and so forth, etc. Which themes have stood out for you in the SMID side, which would have made the way to the model portfolio? I know, for example, healthcare, the weightage has gone up because Metropolis has been added, for example, right? So, but if I look at the 3, 4, 5 months and then I look at investable timeline of 2 years, where within the SMID space do you find the maximum reason?
I see 4 themes that, small subsector themes that I find really interesting. The first is EMS. India's total share of manufacturing as compared to what the total electronics imports are is still very low. And we're seeing concerted policy push to take that up. As a result, you will see continuous growth at very elevated levels for across the most of the EMS companies. They're mostly highly profitable with strong free cash flows. So expecting them to be available at cheap valuations is probably a little unrealistic. But that is, to be a quintessential growth story as far as India is concerned. The second is the aviation space, small subsector, but we are seeing a lot of momentum and huge barriers to entry. The third subsector is internet, where I think internet is in breakout phase. Themes like quick commerce, etc., are causing real disruption to incumbent companies. It would be, I would stay invested in that theme as a structural. The fourth, as you just alluded to, is healthcare. I think healthcare is slowly, moving towards the listed private players. They're gaining market share, and again, long growth runway there. So I'm referring to non-pharma healthcare. So these are 4 sectors which I think look very attractive from a longer term perspective.
Point well made. I think our viewers will benefit from this. Very quickly though, Seshadri, since your note also mentions that you've trimmed position and exited quite a few large caps, so specifically because it's in focus, Reliance Industries, what was the thinking there?
We needed to trim the portfolio anyway, and then when we added SMIDs, we were earlier just a large cap model portfolio by design. So now we've become multi-cap, so we needed to trim some of the names. We looked at it more stock-wise than anything. The sectors that we are largely underweight in, and we've consistently been that for a while, are financials. We think that there is a growth valuation mismatch there. And these quarterly results, while they were mixed and some of them were good, some were bad, we look at the totality of it. Growth across the sector is very anemic. If you look at core PPOP growth or asset growth, they are, the best ones are doing, low double digits. That cannot continue to support a 2+ price to book valuation.
Seshadri, thanks so much. Always a pleasure speaking with you, and we love reading your notes as well. Thanks so much.